So what is LPL Financial? LPL Financial is a great business leader with high incremental returns, winning market share, and improving fundamentals in the advisor-mediated marketplace in the US. There are more than 300,000 advisors in the US, managing around more than 30 trillion assets. And LPL is an important player in that market. It was formed in 1989 through the merger of Linsco and Private Ledger. Linsco was both were broker-dealers founded back then in the late 60s, early 70s. And since 1999, and especially since in 2005, TPG and Hellman and Friedman acquired this business. And then LPL Financial went public in 2011, and mostly since 2015, where there was a change in management. The business has been pursuing an horizontal and vertical strategy, and we will explore in the following slides that what they mean by horizontal strategy is basically trying to expand the affiliation models. And by vertical strategy, it's basically trying to integrate and provide different services to advisors who are ultimately the clients, providing front, middle, and back office support. This is a 30 billion market cap with 5 billion of net debt, headquartered in San Diego, and the new CEO since 2024, it's called Rich Steinmeier. He has been with the firm since 2018. As the number one independent broker-dealer today, LPL Financial serves 30,000 advisors. They recently did almost a 3 billion acquisition of Commonwealth Financial Network, which is bringing another 3,000 advisors to the firm. They run 1.8 trillion assets under management. This 30,000 advisors, Commonwealth is adding close to another 300 billion. Of those 30,000 advisors, nearly half of them are independent advisors, or what we would call from the independent broker-dealer channel. Nearly 6,000 are independent RAs, and there are another 7,000, which is what LPL calls the enterprise business, which is serving smaller banks, basically white labeling their platform to serve smaller banks, credit unions, and ultimately in other insurance businesses that also have wealth management arms. And assets under management are fairly distributed in a similar fashion. And how the business makes money, basically today, what is gross profits? Basically, they have close to 5 billion gross profits, which we would think gross profit as ultimately as revenues. Okay, and I can explain that afterwards. Of those gross profits, close to 30% is client cash. So for you to think about, and the average advisor manages $60 million. Of those, close to 3-4% is cash. Okay, so around nearly, like, I don't know, between 5 to 10,000 of that per client is in cash. Okay, so the average client has around $200,000. So basically, close to 5% of that in cash, which is pretty low amount, which is generally considered as operational expense, which the client would save it to pay taxes or have like one-time expenses like going out for holidays or so. And so what's interesting about this business is that given they serve customers of advisors are affluent clients, generally what LPL can do is they can put the cash balance of 50 billion into a sweep account, and they can invest that at a 3.5% net yield. So with today's rates, that generates around 1.52 billion for LPL Financial. And so the other important revenue lines, 25% is other asset-based revenues, which is participating of investment programs and certainly other kind of fees. And then, of course, there's 1/4 of the business is advisory fees and commissions, which is basically on the advisory business, which it's a little bit more than 50% of the assets under management. LPL pays 85-90% of payout to the advisor, and they keep the other 10%. And then also they have a similar payout on whatever the commission an advisor makes on selling annuities or selling fixed income or mutual funds. So how they grow, this business has been a mid to high teen CPS analyzed growth. It's growing 15 to 20%, or it's expected to grow 15 to 20% of the next years. They have grown AUM 18% annualized or per annum since 2019. What's interesting about this business is there's in terms of assets under management, there's a 98% retention rate. And I did mention the EPS should grow more than 15% over the next years. And this is based on revenue growing, organic revenue growing from 7 to 13%. Market return should add another 3%. And there's an interesting opportunity to expand the EBITDA margins from 47% today to maybe 50% plus. And finally, the company has an incredible capital allocation track record, especially over the last 9 years. And I believe they can continue to add to EPS around 2 to 5% between M&A or buybacks. Just to level set the conversation, basically here in this slide, you can see that how is the market, the advisor-mediated marketplace distributed. There are close to 300,000 advisors, 45,000 or 4 trillion of those 30 trillion are in the independent channel. A similar number, it's what it's called hybrid RIAs, where the advisors can do broker-dealer or RIAs within a platform. And then there's another 5 trillion that work as independent RIAs, that's the figure that someone like us would have. We are, for instance, we have a broker dealer, and we're custodied in a bank, but it's the typical advisor that's custodied in Schwab or Fidelity. There's another 4 trillion that it's in the employee channel, which is basically smaller banks running their practices, or generally what would be an advisor in Raymond James or Stifel, and then you have the wirehouse channel, which is the typical wealth manager at Morgan Stanley or what used to be Merrill, now today Bank of America. And finally, you have the institutional channel, which is what I mentioned before, which is basically serving smaller banks that they don't have the capacity to build their own practice. And so, as we can see, LPL has been growing from being a leader on the independent channel to expanding horizontally, now having offerings for not just the 1099 advisor, but also to the W2 advisor. You can go from being employed, breaking away from a wirehouse, to being employed by LPL, to then going independent into a 1099 contract. And then as well, especially since 2018, LPL has been growing into the institutional channel since they started white labeling the wealth management platform of M&T and then BMO. This has been a great compounder of the last 10 years. It's up like 8x. But as we will see later, most of this market performance, share performance, has been due to EPS compounding. Although I have to say, in general, and I didn't mention before, but the industry has done pretty well as well, because there's an increasing trend of advisors going independent. So going from working at a large bank, at a wirehouse, and seeking independence for different reasons. So we discussed about the investment process, and the first question we need to ask ourselves is this business in a good neighborhood? And I would say the advisory-mediated marketplace in the US, it's massive and growing high single digits, and it has clear tailwinds for independent business models. In the advisors are going independent, and they're outsourcing more and more capabilities, not less. Nowadays, it's not only about there are many turnkey asset management platforms, products that an advisor can have. Most of investment advisory can be automated or can be outsourced. There are a lot of softwares that probably many of you listening to this are aware of, and it's becoming more about like estate planning, tax planning, family planning, and insurance, and many additional services that advisors can provide nowadays. And what's interesting about here, it's the exposure that LPL has mostly to the independent channel, which you can see in the chart in the middle, which has grown 9% annualized since 2019, way higher than wirehouses that are growing at 4%. And given their new affiliation models, LPL has been expanding its addressable market from serving just the independent channel in 2016, adding the employee channel and the institution channel in 2018, and now expanding way more into the wirehouses, which also incorporates it's a more sophisticated sleeve of the employee channel to serve basically high net worth individuals, not just affluent individuals. So, and despite having more than 20% in the traditional independent bank channel, we believe one of the key competitive advantages of LPL is basically their scale. There are not many firms that manage 2 trillion, and they're probably 2 times larger than the next business in the traditional independent channel, consolidating broker dealers, and they're almost 5 times larger than the next player in the enterprise channel, which would be Raymond James. And I think, given their track record, they have proven their right to win, not only in the channels that are already the leader, but also in the RIA space, where they're still pretty small. As you can see on the chart on the left, they have less than 3% market share, and I think they have their right to win not only in the bank channel, where most of that 10% in the enterprise channel is related to banks, but also in the insurance channel, especially since they recently did a JV with Prudential, and so now they're managing. They're white labeling Prudential's wealth management business, which brings another 60 billion to the firm. And I believe for the future, what happened with the bank channel, when first they did a deal with M&T, that led them that followed many deals in the bank channel. Prudential is the first one in the insurance channel, and there's many opportunities to white label to other insurance firms of the near future. Despite being 2 trillion, I would say the market is pretty big. So, and there's still less than 10% of the independent channel, less than 10% market share in the institutional channel or enterprise channel, and less than 1% on the employee channel. And what's interesting about the business as well, they're not only developing new affiliation models or having a horizontal strategy. Another goal of the firm is having a vertical integration strategy, actually on management compensation. Management is compensated on different things, like relative performance of the firm compared to obviously to its peers, but also how do they do in terms of horizontal strategy and vertical strategy. And by horizontal strategy is basically net wins of new advisors. And by vertical integration or vertical strategy, they basically, the KPI they mean is they measure same-store sales. And as you can see, this is the core of the business, which is basically, they're almost like a SaaS. So they're the operating system for advisors, This is mission critical to advisors, and this starts with client works and doing the onboarding for clients, having a really strong compliance muscle. I would say there's like 25 per every 25 advisors, there's one compliance employee at LPL Financial. This is way better than in many peers, many business peers. And they have a lot of economies of scale in terms of technology and the technology services they provide, from CRM, building, if you want to build your website, or any other CMS, and many other SaaS businesses, SaaS offerings that you may probably heard of. They have a 500 million tech budget, which is much more obviously than many of their competitors. So jumping onto business quality, I think this is a very interesting business. Not only their scale, so we discussed about the business quality obviously in the earlier slide, but it's not only about scale, but also I think what's interesting here, I think the business is still under earning, and they have a lot of runway to continue to monetize the business. Today, the gross profit ROA is 29 basis points, and I think they can easily take this to maybe 35 or more. And as the firm frames it, historically, an advisor would do brokerage, so would earn commissions. Then it starts running a fee-based account, so earning higher fees, and that generates generally 25 to 30 basis points of fees of gross profit for LPL Financial. And then as they move into new affiliation models, like the independent or employee business model, and as the LPL also offers their centrally managed platform, where today of the 2 trillion, close to 200 billion are run or managed by LPL's centrally managed platform. And also as advisors start asking for services or demanding more technology services, this gross profit ROA can easily go to up to 40, 45 basis points instead of 29 basis points. Third, but not least, about is this a good business? How is it? What about the management quality of the company, of the business? I think first, what's pretty important is that LPL has a very clear capital allocation framework, and this is basically at the core of their success in terms of allocating capital and